The hate of men will pass, and dictators die, and the power they took from the people will return to the people.
Hello, everyone, and welcome back to Milkshake's Markets Madness. We hope you had a great week. Welcome to our full-length weekend episode. If you're new to the show, visit our YouTube channel. We've got some great intro videos. We have a Start Here playlist that'll kind of help you understand the conversations we have here generally. And all of our videos are broken into segments, and those segments have their own playlist. So I think you'll find it easy and enjoyable to get caught up on some of the conversations and maybe perhaps binge watch some of our content. Now, Brent, we did a flash market update early in the week after the CPI print, a huge market response to that. And since then, it kind of feels like that was an exciting first inning. The bats were swinging, home runs were being hit. It was a wild time. And then the next 8 innings of the week were pretty much as boring as they come, would you say?
Yeah. Today was so boring. Oh my God, watching paint dry. But yeah, so Monday was pretty benign. Everybody's waiting for the CPI report. CPI comes in a little bit soft, and here's the thing: is I think the market reacted correctly because the CPI came in soft and equities rallied. The dollar sold off. Bonds had a big move. Gold jumped, and it totally makes sense to me. But the magnitude of it, to me, it was too much. It was an overreaction to a fairly benign CPI print, and then the next 3 days kind of bear that out. So on Tuesday, on the day the CPI came out, S&P, Nasdaq both jumped big. Gold jumped. Dollar fell. But then literally, if you look at all of these charts since, Wednesday, Thursday, Friday, they're flat. They didn't really go anywhere. And I kind of feel like that if Tuesday's CPI data was really like the catalyst for the next sustained move higher, we would have seen at least a little bit of follow through. Now, this is not to say that we can't have follow through. I'm just, giving my view, looking at the data this week and everything that happened after that. And to me, when a market only moves on Fed speak or only moves on the expectations of the Fed, I understand it. That's kind of the world we live in, but that's not exactly a robust signal to me that's a sustainable thing. So it's going to be interesting to see what happens from here. Well,
given that it was kind of a flat week, but I think there's some very interesting macro themes in play. Why don't we, at least it could be brief on each thing, but why don't we look at some of these bigger sectors, so to speak? So first, share some more on the dollar. So, How did the dollar respond? Do you think that was an appropriate move? Why do you think that was an appropriate move?
Yeah, no, I think it is an appropriate move. So dollar had its worst individual day, I think, since last November. So if everybody remembers, last year was the big move for the dollar, and it peaked. It kind of peaked in September, went sideways, went down into October, bounced up into the first week of November, and then based on the Fed meeting, where the further expectations for rapid rate hikes kind of was taken off the table. And we've talked about this too, where markets trade on expectations, right? And so of November of last year, the rapid rising of interest rates, those expectations were taken away. We knew that there were still possibly be some, but the massive move was probably behind us. And so as the market started pricing in no more hikes and cuts, and that was the expectation, the dollar started to fall. And part of the reason the dollar fell so hard was while they were no longer expecting that to happen in the U.S., they were still expecting rate hikes elsewhere. And so as the dollar fell, the other currencies rose on those expectations. And that kind of stayed the same, through the first half of this year. The dollar was under pressure all year into July, and we had all of the de-dollarization nonsense, and this was it. It was all over this time, and then we had, I think, like 10 or 11 weeks in a row of the dollar going higher from mid to late July into October. And then it kind of went sideways for 2 or 3 weeks. And then I think this is probably the worst week since July. And again, it makes sense. If the expectations that the Fed is now done hiking and there's still expectations for hikes elsewhere, then I think it's a fairly appropriate move. What I kind of find funny is the dollar's still around 104, and I remember there were times where people were telling me the dollar would never even get back to 100, and now it's at 104, and it's all over again. This is it really is it this time. But I would say that there's a couple of possibilities here. It's possible. Let's say we know hard landing. Say the Fed is able to kind of continue a move towards a soft landing, and the rest of the world kind of holds up. The U.S. holds up, and the expectations for other countries to continue to hike slowly, but there's no longer an expectation for the U.S. to hike. Maybe the dollar goes back to 95. Maybe it goes to 90. Maybe we get a melt up for 2 or 3, 4 months into March or April. And the dollar falls and risk assets rally. I mean, that's kind of the melt up scenario. That's not high on my list of possibilities, but I can't rule it out. And so as a result, we've talked about this several times, John, in general, assets tend to go up and to the right. So I hold a basket of assets that go up and to the right over time. But based on the design of the monetary system and the debts in the world, I also know it can be punctuated by periods of severe downturn or severe deflationary shocks or terrifying drawdowns, however you want to define that. So I'm always on the lookout to have some kind of hedges or some kind of downside protection. And so while if we get this melt up scenario either into the end of the year or into the first quarter, we'll do okay. We're not going to press the bet, and we're not going to be levered long for this thing. So anybody that is would outperform us under that scenario. But that's not a deal killer for us, I guess, if that's the right way to say it. The other scenario is that the dollar sells off on expectations that there will be no further tightening of U.S. credit or monetary conditions, and there's the expectation that it will continue to tighten elsewhere, and that just doesn't develop. So maybe the dollar stays soft for a week, a couple days, and then as we start to get more data, maybe it's not quite as dovish as everybody thinks in the U.S., and maybe it's not quite as hawkish as everybody thinks overseas. And it's possible that we're right back where we were at the end of October, 2 or 3 weeks from now. We have the Fed minutes coming out next week. We'll get a little info there. We've got some other central bank activity due in early December. Then we've got another jobs number. So that and then we've got another Fed meeting in mid December. So between now and the end of the year, we could have a total U-turn from the euphoria we've seen over the last couple of weeks. And we've talked about this a couple of days ago on the midweek update, and we talked about it back at the end of October. On one of our weekly episodes, we said that equities were in risk assets were kind of at an oversold level. Wouldn't be shocking to have some dovish commentary out of the Fed meeting and get a 2-week bounce or 3-week bounce, and that's kind of where we've gotten, and that's kind of where we're at. And so, I lean towards there being a pullback into the end of the year. Now, whether that happens or not, I don't know. But those are kind of the two scenarios, and it's really all based on monetary policy and what currencies do. And this is why I pound the table on currencies so much. And until a couple of years ago, nobody even paid attention to currencies. A lot of people didn't pay attention to monetary policy. But now, monetary policy is driving currencies. And currencies are probably the biggest factor that affect investing that most people don't take into consideration. And part of the reason I pound the table on the dollar so hard is it's really hard to get the overall macro global markets right if you get the dollar wrong. And so again, if the dollar falls over the next, let's call it 5 or 6 months, then your risk assets probably rise and we'll do okay. And but if that doesn't happen, if all these expectations that now the tight monetary policy is behind us and all the expectations that the dollar is now going to fall back into the 90s or even the 80s doesn't materialize, then we could have some dramatically different markets than we've seen the last couple of weeks.
So with all of the potential situations or scenarios, those are just some, right? Those are some interesting permutations as to how this could play out. We did in the flash market update, I presented the question to you, hey, do you think this is based on the fact that higher yields help boost the dollar? Is this potentially the top in the dollar? And you kind of extrapolated on that. So I encourage people to for that part of the conversation to go watch that episode. Now, in this particular case, there's something else I want to highlight, which is the point that you made about, hey, if the dollar pulls back, maybe equities rally. That kind of relationship or that phenomenon is a core part of the dollar milkshake theory that I feel like a lot of people overlook, is that keeps the game going.
Yes.
And
yes.
Yeah. And that's, and one other thing I want to mention that perhaps you can, talk about here a little bit too, is two things actually that kind of work together. Like you said, you have the structure of your portfolio. What's interesting about you kind of highlighting these potential outcomes is it's really, for the most part, a intellectual exercise for you. You're not changing anything about how you're investing, and the dollar milkshake theory is not telling people to sell everything they have and buy the DXY index. Right. And I think people get this incredibly wrong. And they boast about these moves in the dollar, and you're not long the dollar in terms of how you're structuring a portfolio. It's not like you're short Bitcoin, long DXY. It's exactly like you just said. Getting the dollar wrong and the role that it plays in the global macro environment means everything else ends up falling apart. So with that in mind, you're speculating, but you're kind of doing it more as an intellectual exercise, because you've taken the time out of the markets to think about how you think this plays out and then built a portfolio around that. But definitely maybe take that comment I made and make it clear that you're not there trading the DXY.
Yeah, that's a good point. And here's the thing, and this is what I'm going to say, is a lot of times people focus on trying to be right all the time. And again, I'm always happy to give my opinion, but I always know that, and while I like to be right, I know that I'm not always going to be right. So instead of always trying to be right, I try to always be prepared for anything, right? And the whole dollar milkshake theory is really a framework that allows me to be prepared for anything. That is the lens through which I see the world. Now, the dollar milkshake is basically a framework for how I think a sovereign debt and currency crisis will play out. And so if that happens, I think that will, and I think we're heading towards, and I've thought this for a long time, that a crisis will play out or a crisis will happen. And the funny thing is even though the crisis hasn't happened, using the lens of how the world would react as we move towards or into a crisis has allowed me to navigate the markets over the last 3 or 4 years pretty well. Now, I haven't done it perfectly, and I've certainly made mistakes along the way, but nothing has surprised me. I've been prepared for everything, and we've done a good job of growing capital while protecting on the downside. That's the lens through which I'm looking at this. And so, we have portfolios that are set up, and the reality is that the dollar milkshake theory basically says that we're going to have a crisis. And the way that central banks respond to a crisis is they tend to print money or debase the currency. That's what history says. And over time, fiat currency loses value over long periods of time. That happens. And so that's why we have a portfolio of assets that tend to go up and to the right over long periods of time as fiat currency loses value. Now, it just so happens we're in kind of a shorter period of time where I think even though the dollar will get debased and it will lose value over time, it is in a scenario where I think it has the potential, at least has the potential, to rapidly appreciate versus other currencies. And I've explained this reason many times. And the problem, and even if all fiat currency is getting debased, if the dollar rallies versus other fiat, that creates the conditions in which these rapid, terrifying drawdowns can occur. And so that is why we are always prepared for those. So even though fiat gets debased over time, you can have deflationary episodes where fiat currency rises in value very quickly. And we've seen that several times over the last 15 years with the dollar. And so I can't in good conscience manage a long portfolio without having some kind of a protection against that. So we have assets that go up and to the right. We have a strategy, an overlay strategy that helps protect against the dramatic drawdowns along the way. And then we do a number of little one-off trades, tactical trades, sometimes that go with our overall thesis, sometimes that go against our overall thesis to try to pick up, a little extra money here and there. But, when I say something like I'm selling oil, I'm not selling oil with 100% of the portfolio. Or when I say I'm buying puts on BITO, which is basically a proxy for Bitcoin, I'm not putting my whole portfolio into puts against Bitcoin. It's just something I see in the market based on either some technicals or some fundamentals or some economic announcements that are coming up and that I think have a chance to make money over call it a two week to 1 month period, whereas our other strategies could be over, a year, 2 years, 3 years. And using this framework, the nice thing about this framework for me is that even if this crisis that I foresee doesn't happen for 10 years, it'll still allow us to make money along the way. And if and when that crisis does show up, I'll be prepared for it. And if at the end this crisis never happens and somebody says Brent's been calling for a crisis for 15 years and it didn't happen, I'll say, you know what, you're right. But you know what, we made a lot of money along the way. So it's not not a horrible thing to have been wrong and made money. If I could make money every time I'm wrong, that would be a fantastic thing, right? So that's kind of what I'm trying to do. I'm trying to figure out how can I position clients' portfolios so that, when we're right, we make a lot of money. When we're wrong, we either don't lose very much or still make a little bit, and and protect and sleep at night as well, and kind of be prepared for anything. So again, rather than trying to be right all the time, I just try to be prepared all the time, and I don't want anything to blindside me. And that's really what this whole framework was allowed me to do. This whole framework, if nothing else, it has allowed me to sleep better at night for the last 4 or 5 years and not constantly worry about the markets. And I have to say, I don't know another framework that has gotten the last 5 years more right than this. This one hasn't been perfect, and I haven't gotten it all right, but I don't know any other lens that I could look at the world through that has done a better job of kind of understanding what's going on and why it's happening than this one.
If you were in a room with a bunch of gold bugs, people who have long-term bearish views on the U.S., on the global financial system, you would fit in very, very well in that room. You would enjoy that conversations. Yeah,
totally.
You would Go ahead.
No, it's important to point this out. I think a lot of times when they hear me talk about this, they think that I am of the belief that everything is fine in the U.S. and everything is a disaster elsewhere. The U.S. has made a bunch of wise strategic decisions. Nobody else can manage their way out of a paper bag. It's actually the opposite. The U.S. has made so many mistakes. They've done so many things wrong, in my opinion, and they continue to do so. And it's my whole framework is a result of all the mistakes. My framework is not as a result of all the good things they have done. It is just how I think the bad consequences play out in the markets. And it's funny because in the very first interview I ever gave, when I was trying to explain this kind of thesis that I was still coming up with, I said, this is a story that ends very, very badly. It's just that the road to the bad end looks different than most people think. And I think that has and I think for the most part, that is right, and I have a lot of people that tell me the U.S. has, made so many mistakes. They're going to go into severe recession and they're going to lose their standing in the world and this and this. And listen, possibly, but it is still so much better off than the rest of the world because of all of the factors and the way that the way the markets will react to all of these bad decisions and consequences will perhaps unfairly still allow the U.S. to be the safe haven in the storm. And so I actually get along just fine with anybody who thinks there's going to be a disaster. The problem is they only focus on the United States. I never walk into a room where everybody's focused on Japan. I never walk into a room where everybody's focused on Germany or Greece. I never walk into a room where everybody's focused on China or Turkey. It's always the Fed, the Fed, the Fed, the Fed, the Fed. These evil central bankers. Jay Powell doesn't know what he's doing. Biden is off his rocker and Trump is crazy and our leaders are idiots. And listen, fine, fair. You think those other geniuses on the other side of the planet have everything under control? Good luck.
I'm glad you said on the other side of the planet and not on the other side of the globe, because then you would be
implying, that's right.
Yeah. So we'll keep teasing our.
You're gonna get us in trouble, John.
Yeah. We'll do a flat Earth conversation another time. So, look, going back a little bit here, we put together the Start Here playlist for a reason, and I think as the channel is growing, there's more. I'll just say friction. I don't really think there's a lot of hate in the comments, but there's a bit of pushback or a bit of poke here and there. And it's very interesting. Like for one example, we do occasionally get a comment that's like, hey, you guys are always just hyping up the dollar. So I think kind of the reason I've steered the conversation the way I have here is because if that's your takeaway, then you're actually missing the conversation. And the Start Here playlist, besides your presentation of the Dollar Milkshake Theory, which I would also say most people haven't listened to or seen from start to finish. So they're only getting these fragments. So they're misunderstanding the overall picture of what you're saying is going to happen. But those other 4 videos talk about this in a more macro sense. And I think give very, very critical and important context to what we're trying to say. And certainly what we're kind of articulating here. And the point I was making about putting you in a room with people who have a bearish or doomer outlook is that you do share that sentiment. The difference is in terms of partly the conversations we have here, but as well as the portfolio construction and the way you're managing wealth, is that there's a timeline for that nobody knows. And so far that timeline has been longer than expected. And the timeline for this end game scenario is going to be much longer if it even occurs. And a lot of people in that room are acting are driven by this ideology or dogma that everything is so bad and that the end of the world scenario is going to happen, and they just continually underperform and miss out on opportunities to grow their clients' wealth because they keep betting on the whole system imploding. So I think that's super important that people realize that you're sharing that sentiment, but just because, like you're saying, you believe that you get to the same end as them, it's just the journey is different and they're not perhaps appropriately allocating capital in that timeline.
Yeah, and here's the other thing is that I part of the reason that I pound the table as hard on the dollars I do is, again, it is, in my opinion, the single most important variable to understand if you're going to get the overall markets right. The other reason I do it, and because of that first thing I think is right, there is so much, I think, bad information about death of the dollar or the de-dollarization or maybe not the death of the dollar, but it's going to be used less and it's going to fall in value. And it's not that can't happen. It's just that the certainty with which it's delivered, I feel like there needs to be another voice on the other side countering that. And then the other thing is, let's pretend for a second that I was pounding the table on the dollar and that's all I talked about it. Well, you know what? That's kind of been the right place to be, right? So even if that was my goal, to just pound the table on the dollar and just be long the dollar's up since all of this madness started back in 2008. The dollar's up like 20 or 25%. Right? So, I mean, think of everything that's happened since COVID. Think of all the crazy monetary policies, all the bailouts, all the stimulus. The dollar's higher now than it was before COVID. So again, it's not that I don't necessarily want to hammer on the dollar. It's just that I think it's so important. I want people to understand why it's so important. And if they use that as their framework, or at least as part of their framework, I think it will help them see the world in a better way. This kind of leads me into something else, John. We've talked about this a little bit, but I'd be interested to get the audience feedback. So feel free to respond to this in the comments. Is a lot of times I have done, a number of different interviews, podcasts, and these podcasts are anywhere from, sometimes they're 25 to 30 minutes and sometimes they're an hour. But even in an hour, it is, or I'll go to conferences and I give a 30-minute presentation. The problem is to really understand the framework. I could spend so many hours just on one piece of the framework. Let's say there's 6 pieces to the framework. I could do an hour to 2 hour presentation on each individual chapter. And there's just not enough time when you do a podcast or you do an interview or you go to a conference to fully explain that. So one of the things we've kind of been thinking about doing as part of this channel is at some point, maybe early part of next year, is we'll have a day where we'll just have an online seminar, for lack of a better way of saying it. And we'll do an hour or 2 hours on all of these different chapters. So it'll be an all-day thing. And I can really give you a deep dive on the framework for how I even think about markets. I don't know if that would be of value to people or not, but if that is something that people would think would be of value, I'd be interested to get that feedback, because sometimes, we do these interviews and they'll say, well, hey, you didn't address this, or hey, you forgot to talk about this, or what about this? And the thing is most of this stuff that gets asked to me, I've thought about it. Not everything, and it's not to say that I can't learn anything new, but this whole framework comes as a result of 15 years of doing this. I've been doing it for 25, and I've been thinking about this specific issue for 15 of it. And so it's not something that I've come by lightly. There's a lot of stuff and a lot of work that's gone into it. And if we can figure out a format via which to share that, and if it's of interest to people, maybe that's something that we'll do.
Yeah, look, if you don't have 20 grand and don't have the time to spend a weekend in St. Bart's with you, maybe a seminar, a live recording where we can, bring some of the community together and have a conversation would be of value. So it'd be interesting to get people's take on that. We have a number of things that we're kicking around now that there's a bit of a cohesion in terms of the views and the follows and the comments. And we really appreciate the growth of the audience and the interaction. So we're now thinking of ways where we can make that interaction a little more personal. That's, one of those ideas. And I think if we're not going to do it in person in St. Bart's or in Rincon at Cuppy's Palace, maybe online is the next best option.
Yeah.
And yep, go ahead.
No, hey, before I forget, when I wanted to bring something up. We were talking earlier about how, could we have a melt up from here, or is it more likely we have a pullback into the end of the year? I meant to mention something then, and I didn't do it. But for those who have followed along with us all year, if you remember at the very end of last year, it's pretty interesting. So far, the fourth quarter of this year is playing out very similar to the fourth quarter of last year. We had a big ramp up we had a big sell-off in Q3 and then a big ramp up in November last year. We're kind of having that same thing again here. And at the end of last year, I had said that, we were still expecting a pullback this year, but what could shoot the market higher at the beginning of the year was the sentiment was very high, sentiment was very low, and the put call ratio was very high. And it was its highest on record. And that was a way of saying, the market's probably oversold. It's probably due for a rally. Well, yesterday, the put call ratio was lower. So the exact opposite of the melt up scenario back at the end of December was at its lowest point other than in July. So the total opposite. So think of where we were yesterday post CPI. We've had this huge melt up over the last 2 weeks, a melt up just since Tuesday. Everybody's bullish. Sentiment now is high in equities and gold and everything else. And the put call ratio was at its lowest point of the year. So I think that's and so again, it's not that I think the market misinterpreted anything. I just think it's gotten way ahead of itself. And so if we were to even have just a little bit of a reversion to the mean, it wouldn't take a lot for equities to pull back 4 or 5%.
Yeah, look, one of the things that's worth adding that's really part of what this interjection you just made and what we were talking about before as far as diving deeper in a focused conversation is, I'll give an example that maybe will better articulate what I'm talking about here. We had a number of comments on the flash market update, which was post CPI, that kind of posed the question, hey, why didn't you talk about this anomaly in the healthcare factor, that sector that had really pulled down the inflation data? And, there's so many things that go on a daily basis, picking the granularities, and certainly one like that, which we know is an anomaly, but does it really matter when the market reaction was what it was? And we are very much in this continue to be in this jawbone environment. But the real point I'm making is, you circle back to like, hey, real quick, John, I want to mention this thing. This is what, if you're hanging out with somebody and having a conversation, there's a flow to the conversation. We try to keep these things 30 minutes. Sometimes the weekend goes 40 minutes. I encourage people to try to have these types of conversations with a friend and see how difficult it is to kind of cover a broad base of things that have gone on. There's going to be moments where we just don't get super deep and super granular on things. And so hopefully maybe something that's a bit more of a focused event where, we're not just trying to produce content for a broad base of people. So 30 minutes is about a cap where we can spend a few hours, and the people who are there for that want that deep dive. I think you'll see that we'll pull the layers back on some of these things and get into more of the granularities. But when we're doing this show, there's so much to discuss, and there's so much to go through that, sometimes these really finer points, are they worth talking about? Sure, but so are the other 10 that we're trying to do a 40,000 foot view on. So speaking of, we are about 30 minutes in right now. And I think before we wrap up, it's probably worth mentioning, we started out the conversation basically, hey, Brent, it's been a slow week. Why don't we look at some of the core sectors? We started with the dollar, and this is another perfect example. Here we are 30 minutes in. We haven't really talked about anything else. So tangent. Yeah. So why don't real quick, give us your thoughts. Yep. I think first on oil, because you had a successful oil trade when it bottomed recently. But it feels like oil is finally becoming more of despite wars and everything else, a recession indicator. It just doesn't want to rally from here.
Yeah. So, this goes back to these tactical trades that we'll do. Sometimes if we see an opportunity that we think might play out over 2 weeks, 3 weeks, 4 weeks, that kind of go against our long-term view, we're happy to do it. Shorting both gold, the gold miners, or having puts on gold, and the gold miners, and be short oil and buying puts on Exxon. These are perfect examples. And so those have worked out really well for us recently. We've traded oil very well. We've wanted to get long oil all year, and we just didn't think it was time. And the people who are very bullish energy, and it's not that I disagree with them. I do agree with them. We have a very bullish setup for energy. It just does, but it doesn't mean it has to start right now. And so we were waiting, and then we saw an opportunity. It's funny, the weekend that the Middle East war broke out, we were short oil and gold. Imagine going into World War III being short gold and oil. That's not exactly a comfortable feeling, but those trades actually worked out for us. So we were short oil around $90. We had puts. The oil pulled back to about 86 it pulled back to about 7. No, sorry. We were short at 90. It pulled back to like the high 70s. We sold our puts. Oil bounced a little bit. We covered the oil at around 86. So we didn't make as much on the futures as we did on the puts. And then we were waiting, and 2 weeks ago or a week ago, oil fell down to like 75, and we bought at around 75, and then we sold it on Monday at around 79. So we've had 2 very good tactical trades on oil. I actually think oil was up again today, but I think actually oil is going to pull back again. I think we're going to get a pullback into next week, the week after. And so we're looking to get long again. And so we're not short it right now. We don't have a position on it right now. We do still have some puts on Exxon, which I think those will go lower, or those will pay off if oil goes lower. But we'll be looking to buy energy, and we might get an opportunity to do it kind of in the low 70s or even mid 60s, which I think would be a gift if we get that opportunity. So yeah, I'm bullish energy long term, but I think in the short term, if things don't go the way a lot of people think it will, then we might have an opportunity to get it fairly cheap.
And then how did your Bitcoin trade play out?
Well, not very good. Not very good. Can't win them all. No, so that's another good example. So it was a couple of weeks ago. It was the day of the Fed meeting. Bitcoin had kind of been trudging along, and then it had a big pop. We thought that the reaction to the Fed meeting had the potential to be dovish, but we also thought the market might misinterpret the dovishness after a day or two. Or we thought even though the market might pop on the Fed, we thought it would give it away over the next couple of weeks. It didn't. And so I think that Bitcoin is actually not the perfect, but probably the best pure play on global liquidity. And so Bitcoin has done very well over the last couple of weeks, or it did do very well over the last couple of weeks as the dovishness came out of the Fed meeting and subsequent Fed speakers. But here's what was interesting is it went up a lot, but then it's back to about where it was when we bought the puts. And these were just 2-week puts. It was literally it was a small trade. We thought we had an opportunity to profit. We didn't. We lost the money on our puts. So to all the people, and there were a lot, all you got to do is go find my tweet on Twitter and look at all the replies saying what an idiot I was, how I was going to get my face ripped off, and I wasn't going to make it, and I was going to have fun staying poor. You know what? You were right. My puts did not pay off. You guys got me this time. When I get it wrong, I admit I got it wrong, and congrats to those who got it right, because I did not get this one right.
Well, I don't think you had a lot of counterparties to that trade. I think you just had Bitcoin fanboys barking at you for not believing in their ideology, which is fine. There's a time and a place for a conversation about crypto. It's not going to be this episode, and there'll be a time and a place to get very, very long crypto, and perhaps it's just not in this year. Although it has performed very, very well. It's more or less up 2x. So anyone who had the hands to buy the falling knife at the end of last year, right around that 17,000 mark, enjoy your profits. Well done.
Yep.
We're a little short on time here, but I think what will be a good idea is one market we didn't talk about that has been benefiting from the drop in inflation and more or less the Fed's decision to pause and the language that they use has been the bond market. In correlation to that is the banking sector, because they have been getting crushed with outflows because of higher interest rates and people moving money into government bonds and money market funds. We haven't really dove back into that, but the situation is still the same, if not slowly getting worse. So I think potentially what will be interesting is before the Thanksgiving holiday kicks off on Thursday, maybe we do a midweek update that focuses on that, partly because Tuesday we have Fed minutes, and we'll talk about what's on the econ calendar in our Monday peak of the week. So stay tuned for that. And but yeah, maybe we'll have a midweek update. We can dive into Fed minutes, the bond market, and what's the situation in the banking sector. Brent, before I kind of guide everyone out here and tell them where they can connect with you and us in the show, any final remarks?
Yeah, the one thing we didn't talk about, which I wanted to just touch on briefly, because in a certain extent, it was a lot of show and not a lot of dough. And I think these events are very much just for photo ops more than anything else. But we had the Asian Pacific Economic Summit in San Francisco this last week, and it's a big deal. Leaders from all over the world come. Xi came from China. That's a big deal. And so, he and Biden had a 4-hour meeting. A lot of that's the thing. I don't know if people realize a lot of the stuff that they end up talking about is kind of scripted ahead of time. They spend months preparing for these things, so they know what's going to be on the agenda and what they're going to discuss. And the outcome of it was pretty much what you would expect. And they basically said the right things. What I found interesting was that then this is just Anthony Blinken. I don't think he's the biggest genius in the world. To start off, but then he's got to try to cover for senile Biden's gaffes. And when at the end when Biden was asked if he still considered Xi a dictator, he said, "Well, yeah, he is." And here's the thing, he is, right? So it's not that Biden said anything. On the one hand, they want politicians to be more truthful and not just say things just to get the reaction, right? But then on the other hand, when he does say the truth, he gets lambasted for not being a diplomat and saying the right thing and slipping up, right? And so, it's kind of a no-win situation. But again, this is an example of I'm sure they spent weeks preparing for this, and then everything's going great, and at the very end, the boss says something wrong, right? How many people have ever did a project at work or a presentation, and you had it all figured out? And all the boss had to do was walk in and shake the guy's hand at the end, and he comes in and he says something about the guy's daughter and it screws it all up, right? Like, I mean, this is the perfect example of that. And I just gotta, for all the people at the State Department and the work, oh my God. And they even had a video of Blinken, like they're showing his face when Biden makes it, and he just wants to put his face in his hands. So that was one point. Then the other thing, and this is the point I want to make. She gave his speech, and he gave this long speech, and he said all the right things, probably more diplomatically than Biden. And he said, China doesn't want to be a hegemon, and the world is a big place, and we can all cooperate. Listen, the world is a big place, and we can all cooperate. You know, the U.S. doesn't want the world to be a smoldering heap of ashes. But the U.S. is the strongest country in the world, and it wants to be the hegemon. And anybody who thinks that China doesn't ultimately want to be the hegemon, give me a break. Of course they do. Every country wants to do that. Every leader wants to do that. And so I guess this is a perfect example of when you see Trump or Biden or Pelosi say something, you're like, that's such bullshit, right? Well, when Z says it, you can say that's bullshit as well. It doesn't mean that you don't like China. It doesn't mean that you're racist. It's just he's a politician. And just because he says he doesn't want to be the hegemon doesn't make it true. And then when he says we don't export our ideology to the rest of the world, are you kidding me? They've got Chinese Communist Party centers all over the world where they are spreading communist ideology or the Chinese Communist Party ideology. That if that's not what it is, then what is their purpose? So again, I don't have a problem when people, hold the U.S. politicians to the fire because I do it myself and they deserve it. But when these other leaders say these same things, think about it critically. I mean, do you really think that China doesn't want to be the biggest power in the world? Of course they do. They have a manifest destiny just the way the United States did 200 years ago. So anyway, those are my two comments on the APEC summit. I thought it was it's always interesting to see how these things play out. And this one, it was kind of going kind of boring, but it actually ended with a little bit of fire. So that was kind of good.
Well, one of the things we also highlight quite often, especially this past summer, when the BRICS thing and the de-dollarization was such a big phenomenon, the narrative was so strong, is we often highlighted that people take headline for headline value and don't, read into the story further and think about what's being said. I will say, I think the media, particularly the right-leaning media, really spun that gaffe by Biden a little much. When I saw that, the headlines were more or less making it seem like he wanted to pick a fight with Xi or something. And when you really look at it, I mean, it was almost like he was reading a Webster dictionary definition of dictator. I don't think the comment, I don't think there was much to the comment. I don't think, it insulted Xi really at the end of the day when that summit was all said and done. But it's another perfect example of, just look under, make your own opinion, look under the headlines. And for everyone who watches the show, who thinks we have it out for Biden, I think, we're pretty much moderate and we'll take things as they come. And so here you go. We're defending him in this case. I don't think what he said was that big of a deal, but he's definitely full of gaffes no matter what the context. But all right, well, look, this was an interesting one for us. I think it was more kind of a chat versus a coverage of what went on the week. I think it was a necessary one, particularly because we're seeing a good steady growth in the channel. And sometimes the commentary is coming in as if what we're sharing is like this very specific financial advice, or this is a very strong view. I think a lot of people have that dogmatic view of their favorite asset class, whether it's Bitcoin or gold or whatever it is. And that's really not the context from which we're coming at this, nor is it the context from which the Dollar Milkshake is trying to put some very important highlights on the monetary system. So hopefully this is a valuable conversation, and certainly let us know in the comments what you thought, as well as what you think about the potential of doing some side projects with us, whether it's a long form weekend seminar or similar types of things where it's more kind of a small circle conversation where we can get a little deeper and also take some of that pushback from you guys, not necessarily head on, but in a more conversational sense. So we look forward to your feedback. Feel free to reach out with Brent on Twitter at Santiago AU Fund. You can find me on Twitter at John Kutsmeda. You can find this show on Twitter and at YouTube using the handle MilkshakesPod. That'll do it for our full-length weekend episode. As I mentioned, we have a number of playlists on the YouTube channel. Every segment that we do has a specific purpose, a specific thumbnail, and its own playlist. So you can kind of more or less binge watch a conversation that maybe fits what you're trying to hear, learn, or get deeper into. And we have a Monday peak of the week coming up here where we will look at the short week for Thanksgiving, the economic calendar, and give you some thoughts on that. And as I mentioned in this conversation, Brent, perhaps we'll do a midweek episode and talk about bonds, banks, and what's slowly happening behind the curtain there. For everybody, we appreciate you joining us, and we hope to see you guys real soon. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.